Amortization and interest questions. Question 1. At a per-listing meeting in Annapolis, Kara explains a loan whose interest rate may change according to an identified index and margin. Which real estate principal is involved? Option A, adjustable minus rate mortgage. Option B, deed of trust. Option C, mortgage. Option D, annual percentage rate. The correct answer is option A, adjustable minus rate mortgage. Rate adjustments occur at stated intervals and may be limited by periodic or lifetime caps. Payment amounts can rise or fall as the rate changes. Borrowers should understand the initial rate, adjustment rules, and maximum exposure. Question 2. A transaction file for an office building raises an issue involving a loan with an interest rate that remains unchanged for the stated term. Which answer best resolves the classification? Option A, VA minus guaranteed loan. Option B, fixed minus rate mortgage. Option C, defeasance clause. Option D, annual percentage rate. The correct answer is option B, fixed minus rate mortgage. Taxes, insurance, and association charges can still change the total monthly housing expense. Principal and interest payments are predictable when the loan is fully amortizing. The borrower trades rate certainty for the pricing available at origination. Question 3. Which concept should an appraiser apply to facts involving a mortgage made by an approved lender and insured by the Federal Housing Agency? Option A, loan origination fee. Option B, Ginnie Mae. Option C, FHA minus insured loan. Option D, equity. The correct answer is option C, FHA minus insured loan. The insurance protects the lender against qualifying borrower default. The government does not directly lend the purchase funds in the ordinary transaction. Borrowers pay required mortgage insurance charges and must satisfy program standards.
Stressed about your FCLE? We can take FCLE for you remotely and undetected. We always guarantee a pass in payments only after results. To send us an email, scan the code or tap the link in the description and let's get it done.
Question 4. Daria is studying a rule concerning a security instrument creating a lien on real estate to secure repayment of a loan. Which term should be chosen? Option A, loan minus to minus value ratio. Option B, regulation Z. Option C, fixed minus rate mortgage. Option D, mortgage. The correct answer is option D, mortgage. The debt itself is evidenced by a separate repayment promise. The borrower retains ownership while granting the lender a security interest. Foreclosure procedures may be used if the obligation is not performed. Question 5. When a historic residence transaction involves the borrower's written promise to repay a debt under stated terms, which answer identifies the controlling concept? Option A, promissory note. Option B, discount point. Option C, deed of trust. Option D, pity. The correct answer is option A, promissory note. It is separate from the instrument that pledges real estate as security. The lender may enforce the debt according to contract and applicable law. This document establishes the personal obligation, interest rate, payment schedule, and maturity terms. Question 6. A practice question describes the percentage relationship between the loan amount and the property value used by the lender. Which response is best? Option A, equity. Option B, loan minus to minus value ratio. Option C, VA minus guaranteed loan. Option D, adjustable minus rate mortgage. The correct answer is option B, loan minus to minus value ratio. Lenders use the measure to evaluate collateral risk and insurance requirements. A lower ratio generally means the borrower has more equity in the transaction. The ratio is calculated by dividing the loan by the applicable value or purchase minus price measure. Question 7. During a settlement preparation, which principle is illustrated by a federal corporation that guarantees securities backed by qualifying government minus insured or guaranteed loans? Option A, hypothecation. Option B, FHA minus insured loan. Option C, Ginnie Mae. Option D, loan origination fee. The correct answer is option C, Ginnie Mae. The guarantee supports mortgage minus backed securities containing approved loan types. The organization does not buy conventional mortgages in the same manner as the major sponsored enterprises. Its role concerns the securities rather than direct consumer lending. Question 8. Which answer states the concept associated with a standardized expression of the cost of credit that includes interest and certain finance charges? Option A, balloon payment. Option B, mortgage. Option C, secondary mortgage market. Option D, annual percentage rate. The correct answer is option D, annual percentage rate. It is not necessarily identical to the note interest rate. The figure helps consumers compare loans with different fees and rates. Required calculation rules determine which charges are included.
Are you looking for FCLE actual questions? Visit our website pokerexams.com to access FCLE study guide with actual questions and answers. Scan the QR code or click the link in the description to get FCLE answer key today.
Question 9. A property manager handling a rental home in Towson must identify a government-sponsored enterprise that purchases qualifying residential mortgage loans in the secondary market. Which choice is correct? Option A, Fannie Mae. Option B, adjustable-rate mortgage. Option C, balloon payment. Option D, VA-guaranteed loan. The correct answer is option A, Fannie Mae. Its activities support liquidity and standardization in housing finance. Loans must satisfy applicable eligibility and documentation standards. The organization does not usually make retail home loans directly to individual buyers. Question 10. During a marketing review for a condominium unit in Gaithersburg, Malik needs to identify the rule described as prepaid interest equal to 1% of the loan amount. Which answer applies? Option A, promissory note. Option B, discount point. Option C, loan minus to minus value ratio. Option D, mortgage. The correct answer is option B, discount point. Points should be distinguished from origination charges and down payment. Borrowers may pay points to obtain loan pricing offered by the lender. The dollar cost depends on the principal amount rather than the property price. Question 11. A salesperson is reviewing a cooperative unit in Bowie. Which term describes pledging property as collateral while retaining possession and use? Option A, pity. Option B, adjustable-rate mortgage. Option C, hypothecation. Option D, mortgage. The correct answer is option C, hypothecation. Default can allow enforcement against the collateral under the security instrument. The concept differs from transferring full ownership to satisfy the debt. The borrower grants a security interest without physically delivering the real estate to the lender. Question 12. At a lease negotiation, a Maryland exam candidate encounters the following description: a loan provision allowing the lender to demand repayment when the secured property is transferred without permitted consent. Which concept is being tested? Option A, pity. Option B, FHA-insured loan. Option C, RESPA. Option D, due-on-sale clause. The correct answer is option D, due-on-sale clause. A buyer should not assume the existing financing can remain in place. Federal and state rules may create exceptions for certain transfers. The clause limits the borrower's ability to transfer the property subject to the existing loan. Question 13. Farah is assisting with a warehouse transaction in Cumberland. Which principle applies when the facts involve the combined housing payment components of principal, interest, taxes, and insurance? Option A, pity. Option B, loan origination fee. Option C, annual percentage rate. Option D, VA-guaranteed loan. The correct answer is option A, pity. Lenders use the total to evaluate the borrower's recurring housing obligation. Association fees and mortgage insurance may also be considered in underwriting even though they are not part of the acronym. Escrow accounts commonly collect the tax and insurance portions. Question 14. Which answer most accurately identifies the market in which existing mortgage loans are bought and sold after origination in a real estate transaction? Option A, adjustable-rate mortgage. Option B, secondary mortgage market. Option C, VA-guaranteed loan. Option D, equity. The correct answer is option B, secondary mortgage market. Investors evaluate the credit and payment characteristics of the loan pools. Loan sales replenish lender funds and support continued lending. The borrower generally continues making payments to the designated servicer. Question 15. A question arising during due-diligence meeting concerns the percentage of gross income committed to qualifying monthly debt obligations. Which choice gives the best classification? Option A, loan origination fee. Option B, FHA-insured loan. Option C, debt minus to minus income ratio. Option D, VA-guaranteed loan. The correct answer is option C, debt minus to minus income ratio. Lenders compare housing expense and total recurring debt with income. Program guidelines determine which debts and income sources are included. The measure helps evaluate repayment capacity rather than collateral value. Question 16. While analyzing a single-family home, Wendy must apply the concept involving a security instrument involving a borrower, lender beneficiary, and trustee. Which answer should be selected? Option A, Fannie Mae. Option B, RESPA. Option C, conventional loan. Option D, deed of trust. The correct answer is option D, deed of trust. The borrower's repayment obligation remains in the promissory note. The trustee holds authority connected to the security arrangement for the benefit of the lender. State law determines the foreclosure process and the parties' precise rights. Question 17. Which real estate term is defined by coverage protecting a conventional lender when the borrower has a high loan minus to minus value ratio? Option A, private mortgage insurance. Option B, acceleration clause. Option C, Fannie Mae. Option D, balloon payment. The correct answer is option A, private mortgage insurance. It does not protect the borrower from foreclosure or eliminate the debt. Cancellation rights depend on law, payment history, and the remaining balance. The premium compensates the lender for part of the default risk. Question 18. In a transaction involving a waterfront parcel, which rule controls when there is the federal law addressing settlement minus service disclosures, escrow practices, and prohibited referral arrangements for covered mortgage transactions? Option A, VA minus guaranteed loan. Option B, RESPA. Option C, conventional loan. Option D, FHA minus insured loan. The correct answer is option B, RESPA. It does not set real estate commission rates or guarantee loan approval. The law restricts kickbacks and unearned fees connected with settlement services. Covered consumers receive information about loan and closing costs through required disclosures.
Stressed about your FCLE? We can take FCLE for you remotely and undetected. We always guarantee a pass in payments only after results. To send us an email, scan the code or tap the link in the description and let's get it done.
Question 19. A buyer representative asks about a mortgage loan not insured or guaranteed by a federal housing program. Which answer provides the legally accurate concept? Option A, FHA minus insured loan. Option B, RESPA. Option C, conventional loan. Option D, hypothecation. The correct answer is option C, conventional loan. Private lenders set underwriting standards subject to law and secondary minus market requirements. Private mortgage insurance may be required when borrower equity is limited. The loan can be conforming or non-conforming depending on applicable standards. Question 20. Elena encounters a government minus sponsored enterprise that buys qualifying mortgages and supports secondary minus market liquidity during a contract revision. Which principle should guide the analysis? Option A, promissory note. Option B, due minus on minus sale clause. Option C, acceleration clause. Option D, Freddie Mac. The correct answer is option D, Freddie Mac. It establishes standards for loans it is willing to purchase. The organization helps connect mortgage originators with capital minus market investors. Retail borrowers normally obtain funds from lenders rather than directly from this enterprise. Question 21. Which choice best matches the description a mortgage program providing an eligible veteran borrower with a federal guarantee benefit? Option A, VA minus guaranteed loan. Option B, loan minus to minus value ratio. Option C, prepayment penalty. Option D, balloon payment. The correct answer is option A, VA minus guaranteed loan. The guarantee reduces lender risk and can permit favorable financing terms. The program is not a direct grant of the purchase price to the borrower. Eligibility and property standards must be satisfied. Question 22. During review of a subdivision lot in Silver Spring, the parties discuss a charge imposed under the loan terms when principal is repaid before the permitted time. Which term applies? Option A, loan minus to minus value ratio. Option B, prepayment penalty. Option C, promissory note. Option D, amortization. The correct answer is option B, prepayment penalty. Borrowers should review the note before refinancing or selling. The provision compensates the lender for early termination of expected interest income. Its enforceability and disclosure are controlled by law and the loan program. Question 23. An exam scenario presents the owner's value interest after subtracting liens from the property's market value. Which answer is most accurate? Option A, VA minus guaranteed loan. Option B, due minus on minus sale clause. Option C, equity. Option D, discount point. The correct answer is option C, equity. It can decline when market value falls or additional debt is placed on the property. The amount is not the same as cash flow or taxable income. The owner's net value can increase through principal reduction, appreciation, or improvements. Question 24. A licensee preparing for a lease negotiation must recognize the federal credit law requiring clear disclosure of borrowing costs such as annual percentage rate and finance charge. Which concept does this describe? Option A, acceleration clause. Option B, pity. Option C, prepayment penalty. Option D, TILA. The correct answer is option D, TILA. The law regulates disclosure of credit cost rather than property condition. Certain residential credit transactions also carry rescission rights. The goal is meaningful comparison of credit terms before the consumer becomes obligated. Question 25. Which answer correctly classifies a situation involving gradual repayment of a debt through scheduled installments of principal and interest? Option A, amortization. Option B, RESPA. Option C, pity. Option D, adjustable minus rate mortgage. The correct answer is option A, amortization. Each payment is allocated according to the loan terms and remaining balance. Early payments on a level minus payment loan usually contain more interest than later payments. Full repayment occurs at maturity only when the schedule completely reduces the balance.